In this chapter, we are going to show you 8 pattern strategies so you may trade like a pro. If you want to show us some support, please hit the like button and subscribe. There are a ton of patterns that traders use, but we will cover the top 8 that most occur. Head and shoulders, double top, triple top, rising wedge, inverse, head and shoulders, double bottom, triple bottom, failing wedge. The head and shoulders pattern is a powerful tool in technical analysis, signaling potential trend reversals in financial markets. In this short guide, we'll explore what the head and shoulders pattern is, how to identify it on price charts, and how traders can use it to make informed trading decisions. The head and shoulders pattern is a reversal pattern that typically forms after an uptrend. It consists of 3 key components. Left shoulder. This is the first peak in the price chart, formed during an uptrend. Head. The head is the highest peak in the pattern, representing the apex of the upward move. Right shoulder. The right shoulder is the third peak, usually lower than the head and similar in height to the left shoulder. To identify a head and shoulders pattern, look for the following characteristics. An uptrend precedes the pattern. The left shoulder forms, followed by a retracement. Pullback. The head forms, reaching a higher high. Another retracement occurs after the head. The right shoulder forms, failing to reach the height of the head. A neckline connects the lows of the troughs during the retracements. Double top patterns. Reversal trading. When the price breaks below the neckline after the formation of the second peak, it signals a potential reversal from bullish to bearish. Traders may consider short positions or exiting long positions. Price targets. To estimate the potential price decline, measure the distance from the peak to the neckline and project it downward from the breakout point. Confirmation. Employ other technical indicators or chart patterns to validate the double top pattern before making trading decisions. The triple top pattern is a bearish reversal pattern that typically forms after an extended uptrend. It's characterized by 3 distinct price peaks with 2 troughs, valleys in between. Here's how it typically unfolds. First peak. The price reaches a high point, marking the end of the current uptrend. First trough, valley. After the first peak, the price experiences a decline, forming the first trough. Second peak. Following the first trough, the price attempts to rally but falls short of surpassing the level of the first peak. Second trough, valley. After the second peak, another decline occurs, creating the second trough. Third peak. The price makes a final attempt to rise, but once again fails to exceed the first peak's level. To recognize a falling wedge pattern, pay attention to these key traits. An established downtrend precedes the pattern. The price forms lower highs and lower lows, with both trend lines converging. The upper trend line is less steep than the lower trend line. The pattern typically suggests diminishing selling pressure. Traders employ several strategies when dealing with falling wedge patterns. Reversal trading. When the price breaks above the upper trend line after the formation of the falling wedge, it signals a potential reversal from bearish to bullish. Traders may consider long positions or exit short positions. Price targets. Estimate the potential price rise by measuring the height of the pattern at its widest point and projecting it upward from the breakout point. Confirmation. Utilize other technical indicators or chart patterns to confirm the falling wedge pattern before making trading decisions. Head and shoulders patterns. Reversal trading. When the price breaks above the neckline after the formation of the second trough, it signals a potential reversal from bearish to bullish. Traders may consider long positions or exit short positions. Price targets. Estimate the potential price rise by measuring the distance from the head to the neckline and projecting it upward from the breakout point. Confirmation. Leverage other technical indicators or chart patterns to validate the inverse head and shoulders pattern before making trading decisions. Double bottom patterns. Reversal trading. When the price breaks above the neckline after the formation of the second trough, it signals a potential reversal from bearish to bullish. Traders may consider long positions or exit short positions. Price targets. Estimate the potential price rise by measuring the distance from the trough to the neckline and projecting it upward from the breakout point. Confirmation. Utilize additional technical indicators or chart patterns to validate the double bottom pattern before making trading decisions. The triple bottom pattern is a bullish reversal pattern that typically forms after a prolonged downtrend. It's characterized by 3 distinct troughs with peaks in between. Here's how it typically unfolds. First trough. The price reaches a low point, signaling the end of the current downtrend. First peak. Following the first trough, the price experiences a rally but encounters resistance and forms a peak. Second trough. After the first peak, the price declines again, but doesn't reach the depth of the first trough. Second peak. Following the second trough, another rally occurs but faces resistance and forms a second peak. Third trough. The price once again dips but stays above the first 2 troughs, forming the third and final trough. The rising wedge is a bearish reversal pattern that typically forms after a sustained uptrend. It's characterized by converging trend lines that slope upward. Here's how it typically unfolds. Upper trend line connects the highs of the price, showing a series of higher highs. Lower trend line connects the lows of the price, displaying higher lows. Converging trend lines. Over time, the price movements become confined within these converging trend lines, RST peaks level.